In 1988, a mathematics professor with no Wall Street experience, no finance degree, and no trading background started an investment fund. Over the next 30 years, that fund returned 66% per year, every single year, without exception. $100 invested in 1988 would be worth $8.4 billion today. This is not a story about luck. This is a story about how one man broke the rules of investing and won. His name is Jim Simons. Before he became the greatest investor of all time, he was cracking Cold War codes for the US government and teaching geometry at MIT. He had never worked on Wall Street. He did not read financial news. He did not follow economic trends. He did something completely different, and Wall Street hated him for it. Today, I am going to tell you the full story of how Jim Simons built the most successful investment fund in history, what he discovered that everyone else missed, and why his strategy completely changed how I think about money. Stay until the end, because the secret I will share changes everything about how you should be investing right now. To understand why Simons was so remarkable, you first need to understand what everyone else was doing wrong. In 1720, Isaac Newton was one of the smartest people alive. He had calculated the motion of planets. He had invented calculus. He was worth 30,000 pounds, the equivalent of $6 million today. And then he lost a third of his entire fortune in the stock market. When people asked him why he did not see it coming, Newton said he could calculate the motions of heavenly bodies, but not the madness of people. For 300 years after Newton, investors tried to predict markets the same way. They read news, they studied companies, they followed gut instincts, they trusted experts, and 90% of them consistently lost to the simple average of the market. The best minds on Wall Street, with all their research teams and Bloomberg terminals and decades of experience, could not beat a simple index fund over the long term. The market seemed impossible to crack, until Simons asked a different question entirely. Instead of asking what companies are worth investing in, Simons asked a completely different question. Are there hidden patterns in market data? Not stories, not opinions, pure data. He hired physicists, mathematicians, and computer scientists. Not a single one had ever worked in finance. He told them to ignore everything they knew about investing, forget what companies actually do, and just look for patterns in the numbers. And what they found changed everything. The fund they built was called Medallion. And the results were unlike anything the financial world had ever seen. From 1988 to 2018, Medallion averaged 66% annual returns. For context, Warren Buffett, widely considered the best traditional investor alive, has averaged around 20% per year. The S&P 500 averages 10%. Simons did not beat the market. He demolished it for 30 years straight. So how did he do it? Simons built what is now called a quantitative trading system. His team collected every piece of market data they could find, going back decades. Weather patterns, lunar cycles, sports results, interest rate changes, currency movements. They fed all of it into mathematical models and let the computers find the signals. Most of the patterns they discovered made no logical sense. They did not care. If the data said it worked, they traded it. Here is what makes this even more remarkable. Simons did not just beat the market occasionally, he beat it during every type of market condition. When dot-com stocks crashed in 2000, Medallion made 98%. During the 2008 financial crisis, when banks were collapsing, Medallion made 80%. While everyone else was losing everything, his fund was printing money. The system did not care about headlines, it just followed the data. Now you might be thinking, great story, but how does any of this help me? I cannot build a supercomputer trading system. And you are right, you cannot replicate Medallion. But what Simons proved changes everything about how you should think about investing. He proved that markets are not random, there are patterns. And he proved that emotion is the enemy of returns. Every time a human made a decision based on fear or greed, they lost. Every time the computer made a decision based on data, it won. This is the practical lesson for every regular investor. Simons did not win because he was smarter than everyone. He won because he removed himself from the equation. He built a system and trusted the system. Most investors lose money not because they pick the wrong stocks, but because they panic at the wrong time. They sell when markets drop. They buy when markets peak. They chase performance. They follow headlines. Every one of these decisions is emotional and every one of them costs money. Here is what the data actually shows about emotional investing. Studies by Dalbar Dalbar, a financial research firm, consistently find that the average investor earns significantly less than the funds they invest in. The fund returns 10%. The average investor in that same fund earns 6%. Why? Because they move money in and out at the wrong times. They are their own worst enemy. Simons understood this in 1988. Most people still have not figured it out. So what can a regular investor actually take from Simons? 3 things. First, build a system and stick to it. Decide your allocation in advance and do not change it based on news or emotion. Second, automate your investments. Set up automatic contributions so you are not making decisions every month. Third, think in decades, not days. Simons ran models on 30 years of data. Your investment horizon should be just as long. The people who got rich from index funds were not the smart ones, they were the patient ones. 3 mistakes that destroy most investors. 1. Checking your portfolio every day. The more you look, the more you react. The more you react, the worse your returns. 2. Following financial news. Simons specifically banned his traders from watching news. It introduced bias. 3. Trying to time the market. Every study ever done on market timing shows it destroys returns. Nobody can do it consistently, not even the smartest people on Wall Street. Jim Simons eventually closed Medallion to outside investors. Today it only manages money for Renaissance Technologies employees. The fund has never had a losing year. In 36 years of operation, not one. By the time he retired, Simons had a personal net worth of $28 billion. Not from a salary, not from luck, from a system built on math, data, and the complete removal of human emotion from the investment process. Now here is the secret I promised you. The reason most people never build real wealth has nothing to do with not having enough money or not being smart enough. It is this: they make investing a daily decision instead of a one-time decision. Simons made his decisions once, built a system, and let it run for 30 years without interference. You can do the same thing in 30 minutes. Open a brokerage account, set up automatic monthly contributions to a low-cost index fund, and then do not touch it. One decision, 30 minutes, 30 years of compounding. That is the entire secret. If this video changed how you think about investing, subscribe to Wealth Decoded. Every week we break down exactly how money works in plain English so you can build more of it. See you in the next one.